Hello, everyone. So we are doing chapter 2, a further look into financial statements from the beginning. Some portion of this was covered in class, but we will be looking at all of this in detail again. Okay, so these are the learning objectives for the class for chapter 2. So we will identify the sections of classified statement of financial position, also called as your balance sheet, and we will describe the framework for preparation and presentation of these financial statements. Now, we talked about a balance sheet. So balance sheet looks something like a T account. So this is a classified balance sheet. Okay, so statement of financial position is the name of the statement under IFRS standards, and under ASPE accounting standards for private enterprises, we call the same financial statement as balance sheet. So on the left-hand side, we see all of our assets, and on right-hand side, we see our liabilities and shareholders' equity. Now, if you notice, the assets and liabilities are listed into different categories. So your assets are shown as your current assets and non-current asset, which tends to be your long-term assets, and liabilities are broken down into current and long-term as well. So this is a classified balance sheet structure. Okay, so your items are listed into different categories here. So your definition of current is anything that is expected to be paid or received within the next 12 months from the financial statement date is considered as current. Whether that is a current asset or a current liability, the definition of current still remains the same. Okay, so the current asset are items such as your cash, accounts receivable, supplies, inventory, any prepaid expenses, okay, anything that is expected to be used within 12 months. Okay, now we look at two criteria. So we need to take the longer of the operating cycle or 1 year. Whichever of those is longer will determine whether your asset is current or long-term. Okay, now generally speaking, with most of the industries, the 1 year rule still holds true. So for the most part, the 1 year will be the longer term, but there are certain specific industries such as aeroplane manufacturing or wineries where the processing cycle or the operating cycle is longer than a year. Okay, so we will take the transactions when we consider whether they are current or long-term, we need to look at the longer of the operating cycle or 1 year period. That is what determines whether your item will be classified as current or long-term. The non-current assets are also called as your long-term assets. So these assets are not expected to be converted into cash, but the intention is either they will be used in the operations to generate revenue, or they will be held for making profit off of that. So some of the examples of these long-term assets is the long-term investments, which generally the company holds in order to make money off that. Then we have our property, plant, equipment, and intangible assets along with goodwill and other assets. So our property, plant, equipment, we'll talk about our property, plant, equipment in just a second there. So this is a multi-year investment in debt securities, which is your loans, notes, bonds, and mortgages. And for the equity security perspective, we have our shares of other companies. So these assets are not normally intended to be sold within 1 year. So they are classified as long-term investments. Now, there is the intermediate financial accounting course is the one that talks about the investments in much more details. So here we just need to understand the investments on a conceptual level, but they will be explored further in other accounting courses. So our property, plant, equipment. So the long-term asset that the company's purchased, they need to have two criteria fulfilled. One is the life of your asset has to be over multiple years, meaning over 12 months. And second, those assets have to support revenue stream. They have to help the business generate revenue. So Items such as your land, building, equipment, furniture, tools, computers, vehicles, okay? Anything and everything that you can think of when it comes to an asset that has multiple years of life and it does support your revenue generations can then be classified as property, plant, equipment. Now, if the asset does have physical substance, then it becomes part of property, plant, equipment account. If the asset lacks physical substance, then it becomes intangible asset. So when we look at long-term long-term assets or the non-current assets, these assets have to be depreciated over their life. Okay, land is the only item that is not depreciated. Any other item that you're looking at or any other long-term asset in this section has to be depreciated over its useful life. So the process of depreciation is the allocation of that cost over its useful life. So under IFRS, this allocation is referred to as depreciation for physical assets and amortization for intangible assets. Under ASPE, your amortization is often used instead of depreciation. Okay, so just different terminologies, but ideally the concept is still the same. So this is what your depreciation would look like, or your asset along with the depreciation looks like on your statement of financial position or your balance sheet. So your asset is recorded at cost. So in this case, our equipment cost us $400,000. From the time this equipment was purchased, the business has booked accumulated depreciation on that asset for $100,000, giving you a net book value or carrying value of $300,000. So accumulated depreciation is, as the name suggests, depreciation right from the day the business started using this asset up until the financial statement date. So intangible assets, as we said, is also helping the business generate revenue and has life of multiple years, but these guys lack physical substance. So items such as your patents, copyrights, trademarks, licenses, those are all considered as as intangible assets. Okay. Now, intangible assets can have definite life or may not have it. So they are a little bit different in that regard when it comes to property, plant, equipment items. So if they have definite life, then you would amortize those intangible assets. But if they have indefinite life, then you cannot amortize those intangible assets, but we do have to check them for impairment. Right? Now, goodwill. Goodwill is the excessive price that is paid when a new business is acquired, right? So when the business is acquired, what you're paying for necessarily is the equity in that business. So assets minus liability is what we are paying for when a business is acquired. Now, let's say the asset minus liability was $1,000, but we are paying $1,500 to acquire a business. The difference in what you have paid and what you are receiving is your goodwill. Goodwill only comes into play when the new business is acquired. You cannot, or any business, the businesses cannot have internally generated goodwill recorded on their financial statements. And goodwill is not part of the intangible asset. This item comes after the intangible category. It is reflected by itself. Now, goodwill is one of those items that does not have definite life. Okay, it does have indefinite life. In that case, we cannot amortize that asset, so we end up checking this for impairment at the year end. Okay, so when it comes to current liabilities, so liability is something that the business owes. Asset is something that they own, but the liability is something that the business owes. Okay, it has a liability to pay somebody. So liability comes into play from a past, present, and a future transaction. So there was something done in the past. As of present, there is an obligation for us to pay or for the business to pay. And in the future, whenever those liabilities are settled, it will draw your assets down. So liability is an obligation. Okay. Now these obligations, depending on when they are expected to be paid, can be categorized as current liabilities and or long-term liabilities. So current liability is anything that is expected to paid within 12 months of your last financial statement date. So items such as your bank indebtedness, the money that you owe to your bank. So your accounts payable, deferred revenue. Deferred revenue is also called as your unearned revenue, bank loan or notes payable, and current portion of your long-term debt. Here, once again, just as a quick reminder, we are considering the longer of 1 year and operating cycle when you determine whether your transaction is current or long-term. The same idea as your current assets. On the other side of your liabilities, we do have the long-term liabilities. These are the maturing obligations that will be settled after 1 year. And when we say 1 year, we are considering that the 1 year was the longer. So we did consider the operating cycle and the 1 year rule. In that case, we are assuming the 1 year was the longer of those two. So with your long-term liabilities, these are paid or expected to be paid after 1 year's time from your last financial statement date. Things such as your bank loans or notes payable, lease obligations for the business, pensions or benefit obligation, and deferred income tax liabilities. Okay. Usually speaking, in the financial world, there is a whole lot of financial statement disclosure that is required when it comes to long-term liabilities. That brings us to shareholders' equity. So shareholders' equity in essence is your liabilities minus your your asset minus liabilities is pretty much what your equity is. Okay. Now, technically speaking, that equity is broken down into two pieces. One is your share capital, the other one is your retained earnings. Share capital is the money that is invested by the shareholders. Okay, so this is the investment of the cash or the other assets in the company by shareholders. In exchange, they get the preferred shares or the common shares. Retained earnings on the other end is the cumulative net income that the business has retained from the first day of its operations. Something that is still in the business, it hasn't been dispersed out. All right. Now that example is done in the class. Same with example E2-5. Okay, so that brings us to the other half of chapter 2, which is conceptual frameworks of accounting. Now these guides our decisions about what needs to be presented on the financial statements, what would be the alternative ways of reporting on these economic events, and what are the appropriate ways of communicating that information. So this is what we will be talking about in our conceptual framework. So some of the key items that we do look at is the objectives of these general purpose financial reporting. Okay, the qualitative characters of the useful information, the cost constraint, elements that comes to your financial statements, and how do we measure these elements. So this is what we will be talking about here. So objective of your general purpose financial statements is to provide information that is useful to decision makers. Okay, these decision makers could be your existing shareholders, potential investors, lenders, regulatory bodies. They can be very many different types of users to your financial statements. So our job or objective is to provide useful information to these decision makers that they can utilize. So who are making these decisions about providing resources to a company? It's about buying and selling, holding equity or debt, about providing or settling loans or other credits, okay? Depending on your user group, they can make different decisions by looking at your financial statements. So we provide them financial statements to make these general purpose decisions. So about your qualitative characteristics for accounting information. Now there are certain qualitative characteristics that are very fundamental, that is must have, which is your relevance and representative faithfulness. On the other side, there are enhancing qualitative characteristics, which are good to have, which is comparability, verifiability, timeliness, and understandability. So let's look at what they mean. So your relevance and faithful representation is must have, okay? Both of these are must have. So any information that is relevant for decision maker, that will change decision maker's perspective, has to be included into your financial statement. The relevant information can be used for predictive value or for a confirmatory value. What that means is when we provide relevant information on the financial statement, the user of that financial statement can either confirm their understanding. Okay, let's say somebody is looking at the financial statement and they had already purchased the shares prior year, they were assessing the information last year, and now they want to confirm and see if that was a good decision. That's confirmatory value when they are looking at past. Predictive value is when you're looking at these financial statements to make a future decision. That's predictive value. Should I invest in this business? Should I do business with them? Should I buy their shares or should I sell their shares? Okay, so anything in future is with relevance or related to your predictive value. But when you're looking at past for some sort of a confirmation, that's your confirmatory value. The other aspect of relevance is materiality. Any information that is material enough and will change the decision maker's thinking is or has to be included in your financial statements. You cannot exclude that information. That information influences the decision makers, so it has to be included. Faithful representation is the information that reflects the economic reality of the business. So when we are following faithful representation, we have to make sure that the transaction is listed, is complete. All the information or aspects of that transaction has to be listed. You have to completely list the transaction. We have to be neutral. We cannot pick and be biased towards a certain set of users because the same set of financial statements is used by different user groups. So we want to make sure that we maintain neutrality when we are applying or recording these transactions that are material, relevant, and complete. At the same time, we want to make sure that this information presented on your financial statement is reasonably free from error. Okay, not to say that it is 100% free of error, but it has to be reasonably free from errors. So good to have qualitative characteristics is comparability. So what the companies do is the companies want to compare their information from one year to the other, from 1 month to the other, or 1 quarter to the other, or they would like to compare it from one company to the other company. Now that comparability is only possible when the companies follow same set of rules. All right. Now, let's say when you are comparing one company to the other company, one company follows international financial reporting standards. The other company is preparing their financial statements based on accounting standards for private enterprises, which is a private company. Okay. So when one company follows the rules of a public company and the other is following the rules for private company, You are not comparing apples to apples. So comparability in that regard is compromised. You cannot compare unless you look at the companies following the same standard. So the same idea applies to the companies when they compare their information from one year to the other. They have to make sure that all of their accounting standards and practices are consistently applied from one year to the other so that they can compare the information and make those relevant decisions. Verifiability is when independent consensus that information is faithfully represented. What that means is when different users are looking at that information, they should come to the same conclusion. All right. If their conclusion is different, then verifiability is compromised. Example of verifiability here is, let's say if the company says they had $50,000 of cash in their account at end of the year. In that case, that $50,000 have to be verifiable. You can verify it through a bank statement. So different users can look at that source document, which is your bank statement, to verify the information, and they will come to the same conclusion, whether that is yes or no. Okay, so different users should be able to have consensus when it comes to that decision. They should be able to come to the same conclusion for verifiability aspect. Timeliness is making sure that your financial statements are represented in a timely fashion. Okay, keep in mind when the financial statements are presented, the financial statements are historical as it is. Right? So we are publishing, let's say, the financial statements for prior year. That is old information anyways, but we still want to provide this information in a timely fashion so that it is relevant for decision makers to use. Okay, if the financial statements are not presented in timely fashion, then it loses its relevance. So as per the timeliness guidelines and principles, we as in the businesses, have to show or have to prepare the financial statements at least once every 52 weeks, which is a 1 year or a calendar year. All right. Understandability is anyone with basic understanding of financial information should be able to comprehend the financial statements with ease. Okay, it should not be very challenging. It should not be very complicated for somebody with reasonable understanding to go ahead and interpret and make sense of that information. So it has to be presented clearly, concisely. Now, when we talk about all of that, what comes into play is your cost constraint. Cost constraints is also called as cost as benefit. So in accounting world, we always look at cost of implementing a process or the cost of making that change or receiving that information in comparison to the benefit that it is providing. So as long as the benefit out of those changes or transactions is more than the cost, then it's a good decision. But if your cost is way higher than the benefit it's providing, then your cost is a constraint. Okay, then we would not make that change or implement that process because it doesn't make financial sense. There is no economic benefit out of that. Going concern assumption. A going concern assumption is that a business will continue to operate in unforeseeable future. So when the auditors look at the financial statements, one of the last pieces to the puzzle is to check for your going concerns. So the auditors will look at the financial performance of the business and assess whether the business can continue operating given their resources and their commitments for the next 12 months from the last financial statement date that they're assessing. So that's unforeseeable future in accounting world. All right. So when they are assessing the going concern, their major concern is to make sure that the business will continue for that unforeseeable future. If there are any indications that the business will not be able to sustain another year of successful operations and they would have challenges, in that case, your balance sheet or your statement of financial position has to be changed to liquidation accounting method, where all of your assets are reported on the liquidation pricing, meaning if I want to sell those assets today, how much will I get for them? Those are the numbers that will be reflected onto your balance sheet or statement of financial position. The only time I have seen a going concern in my work experience is with a small company that I worked with. So the company had good resources, had good cash flow, and their balance sheet was pretty solid as well. The reason for the going concern in that instance was 90% of their sales were to Walmart. Okay, so how this becomes a going concern is if Walmart um, denies to shelf this company's product, then there is no way the company can sustain their operations and commitments based on the 10% customers that they have outside of Walmart. So that becomes a huge dependency for the business, and that was the cause of going concern in that case. So going concern can come from these things, but most commonly it tends to come from cash. But I guess what I'm trying to tell you here is it can primarily come from cash, but there could be other reasons. Elements of our financial statement. So this is not new for us because we have talked about the financial statement elements at quite a length in topic or chapter 1 as well. So it's more of a refresher and just a quick recap of those items. So elements of your financial statements. Okay, looking at this is your assets, liabilities, equity, income, and expenses. Now, if you think of this, basically they are picking up elements from your income statement and balance sheet, all right? So really, we have talked about your assets, liabilities, and what they mean. And equity, your revenue, expenses. Revenue comes from your ongoing operations, and expenses is something we incur in order to support these revenue streams. Right? So these are the financial statement elements that we have talked about at quite some length now. But what we are looking at now is how to measure these financial elements. So on the date that we recognize them, they are recognized at their fair value. When these transactions come into play, the cost on that day is the fair value related to that. Okay, so the financial statements should have the recognition, measurement, and reported. Okay, so in accounting world, we follow the generally accepted accounting principles, also called as GAAP. So what GAAP is GAAP does have some governing rules and principles that we have to go by. One of them is the historical cost versus the fair value. So historical cost is when the assets and liabilities are incurred, they have to be recorded at cost. Okay, whatever was the cost to the business, whatever money that they paid is what we need to record our assets and liabilities at. Not only at the time of the purchase, but throughout the life of that asset and liabilities, they will be stated at historical cost. Now, if you recall, just a couple of slides earlier, we were talking about an equipment. So there, the equipment cost was $40,000. The accumulated depreciation was $30,000, and the carrying value was $10,000. Oh, sorry, my bad. The equipment at that time was $400,000. The accumulated depreciation was $100,000, and the carrying value was $300,000. So no matter what time, where you are on your timeline with the historical cost principle, that equipment you recorded at 400,000 was the cost when that asset was acquired, and it will sit at historical cost. We cannot change that. The only way we adjust for that in that instance is through your accumulated depreciation account, which will bring your carrying value to a zero at some point in time, okay, or the residual value. And we discuss that concept in much more detail when we talk about property, plant, equipment chapter. But that is historical cost. So when it comes to assets and liabilities, they are reported at cost throughout the life, on day one up until the last day of their life. On the other end, we do have the option of reporting at fair value. Now, there are certain assets and liabilities that should be recorded and reported at fair value. Fair value is the value of that item as of the date of assessment. Okay, so in choosing between these two, we apply the concept of relevance and faithful representation to say which one will represent more fairly, whether we should go with historical cost principle or we go with the fair value method. That, my friends, is all we have for chapter 2, because this example BE2-9 is also or will be done in the class. And finally, I have listed some comparison between IFRS and ASPE here for your review. So there is some basics, earnings per shares, and the differentiation between the depreciation terminologies that we discussed. Under IFRS, the terminology is depreciation for physical assets and amortization for intangible assets. Under ASPE, we just use amortization for all assets. Basic earnings per share, this concept will be discussed in much more detail in the ratios analysis, chapter 14, which is at the end of this course. That is all for chapter 2. Thank you for listening.